It gives me great pleasure now to bring on board Neelkanth Mishra to talk about economy, markets, themes, and what his understanding of the macro is. He's someone I always look forward to interact both on the record and off the record. His understanding and ability to connect the dots and then come up with a strategy which you can really adopt, I think is absolutely brilliant. Well, Neelkanth, good morning. Thank you for joining us. Hope everything is fine. Your kids are fine. Your colleagues are fine, and everybody is safe with you, around you.
Thank you, Nikunj. Yeah, that was a very generous introduction, and yes, thank you for your good wishes. By God's grace, everything is all good here, and hope the same with you.
Thank you very much. Now, before we get into specifics, I just want to first understand on your take on the economy. Last time when we spoke, we were in middle of the lockdown. Things were helter-skelter. Everybody was trying to understand that what would be the shape of the economy. But between our last interaction and now, it's been about 2 months, more than 2 months actually. So what in your mind has changed for the economy, and how do you think we have emerged at the macro level, at the economy level, at the consumption level?
Right. So I think the economy is doing better. The virus, unfortunately, at least in terms of the number of infections, is doing even better. So the number of infections keeps going up. But the economic trajectory has changed. Starting from here, it is important for us to remember is that the improvement in the economy going forward is going to be slow and gradual, right? So in the downturn, we fell to maybe at the lockdown, we fell to maybe 50% of normal. Then we have bounced back. So in our estimate, we are at about 90% of normal right now. About 7% of GDP worth of consumption, about 2% of GDP worth of investment is still restricted, either by regulation or by fear. And then there is some demand overlay. So about 10% of GDP is still not fully back on. So we moved from 50 to 90 in about 3.5, 4 months. But we think that the 90 to 100 will happen over the next 6 months. So 6 to 7 months. And therefore, the pace of normalization is actually going to slow down. So we are seeing some disappointment among people that look, suddenly the sharp recovery is kind of tapering off. At this stage, it has to, because there is quite a bit of restriction still. And in some cases, like, Lonavala saw a lockdown yesterday, etc. So I think there are local governments which are still imposing lockdowns. There are things like, quarantine requirements for travelers, which now seem a bit odd to see because, now almost every district in India has more than 1,000 cases. So from an economic opening up perspective, we think that as local governments and state governments also sort of realize the futility of these weekend lockdowns and the random lockdowns and, these restrictions on travelers, etc., the regulatory constraint on the economy will slowly keep getting lifted. And as the case fatality rates keep going down, I think we are still seeing too many deaths, I think 1,000, 1,100. But the only good thing I will say is that number has not risen, meaning that if we were still at the 3 to 4% case fatality rate, by now we may have been seeing more than 3,000 deaths a day. So we are still at about 1,000 deaths a day. And the incremental case fatality rate continues to fall. What is even more important for us to know is that all these seroprevalence studies are showing that the number of infections is actually far higher than the number of cases we're able to track. And if you were to use a simple ratio, it's not theoretically accurate, but this is the best data we have. The infection fatality rates are more in the order of 0.05 to 0.1%. So as this becomes more widespread, as the disease in the rural areas, seroprevalence is still less than 5%. In the next 3-4 months, I think it will continue to rise. As most places get to that 40, 50, 55% seroprevalence, I think the curve tapers off. Hopefully, the virus keeps becoming weaker over time. And we think that by the fourth quarter, we should be at about 0% GDP growth year on year. that is helped by the structural factors. Before the virus, we were still growing 5-6%, lower than what we should, but we were still growing. So despite that upward surge, or upward what I would call tailwinds, which regularly help the economy, we should be back to about 0% in the fourth quarter.
Neelkanth, 8 out of 10 consumer or auto companies, or for that matter, even most of the construction companies are saying that we are almost there. We are almost back to 80 to 85% of our pre-COVID business. Should we take that with a pinch of salt?
No, we shouldn't. So the situation in both these, the two examples that you gave, and this is actually, I'm glad you asked this question. So when we say we are at 90% of normal, that's in aggregate, right? In some cases, we are at 98% of normal. In some cases, maybe 102% of normal. So the important thing to see here is that even now, diesel demand in India is down 22% year on year, right? So, and why is that? Because, kids are not going to school. School transport or transport to educational institutions is a 1,20,000 crore market, right? We have 33 crore students going to colleges and schools. So that's 1.6% of GDP. You have the interstate transport, which is still curtailed mostly. That's a 4.5 lakh crore market. So there are large parts of the economy, or look at hotels, restaurants, all of the normal things that we discuss, or the fact that, there are maybe 1.5 crore tourists not coming in. And if they stay for 10, 15 days, on average, there is a certain amount of food they consume. The fact that 18% of out of home, of our milk consumption is out of home. The festivities this year have been far lower than normal, right? So the demand for chena and ghee and peda and all, depending on which part of the country you're in, is much weaker. And therefore, I think there are some segments which are down massively, 80%, 70%, 60%. And there are some segments which will be at a higher level. In autos in particular, we have to remember that last year we see, like on personal vehicles, we saw a 20% decline, right? And it was one sector which saw intense destocking. So post the IL&FS debacle in September 18, as the NBFCs withdrew, there was a problem of financing for the channel, wholesalers and retailers. And there was intense destocking, exacerbated by the BS4 to BS6 transition. By March, April, the restocking was expected to happen. So if the restocking is happening now, you will see activity levels which are elevated, because that whiplash, the supply chain bullwhip that we had discussed, I think last year, is at some point has to hit on the upside, right? And so that's why the supply chains for automakers are actually quite robust. For construction, I think back to 80-85% is to be expected. One hopes that with some more restrictions being lifted, they can get to 100% very quickly, because that is one area where with some discipline, we should be able to get the activities normalized as quickly as possible. So no, that's not inconsistent at all with what should be happening.
How should one look at what is happening in the banking sector, especially after the RBI new norms on restructuring? Because some would argue that now you will have to take banks and their assessment and their profits on face value. What should investors do? How does one calculate book value? How does one calculate other ratios?
No, that's a great question. So this is one of the reasons why, while on trailing books, so when you're doing a really hardcore, value-based analysis, you have to look at trailing book, right? So what's the last 12-month book value, and how are stocks and sectors doing on that? And the market is more or less back to where it was on trailing book. Maybe 4% lower, but is more or less there. The banks are still 30% lower. Right. And one of the most important factors is exactly what you mentioned, that if you put a moratorium and then you have some element of restructuring, the contours of which will be available to investors with a lag, and then hopefully some banks will be much more prompt in disclosing and with transparency, then the price to book multiple has to go down. So I think that lack of clarity is, I think, a very important factor. The other elements which can potentially drive down the stock, like, lower growth, the fact that corporates may not be borrowing as much, that there are, as the economic nominal GDP growth slows down, the demand for loans will be much weaker. I mean, all of those factors apply as much to the other stocks in the market than the rest of the banks. The interesting thing is the market going overboard with this de-risking? So if you do very simple high-level analysis, and I know there are, more rigorous ways of doing it, but from a big picture perspective, if the change in the trailing price to book for the banks, private banks and PSU banks, was the same as that for the market, which means that, just 4% lower or almost the same. The book value, but right now it's not, right? Which means that the market is assuming a certain erosion in book value. So the market doesn't trust the book, right? Now, as that erosion of book value is quantified, if you quantify it like that, you will see that there's almost a 3 trillion rupee, 3 lakh crore erosion in book value that the market seems to be pricing in. This is very simplistic. You should actually be doing it on implied ROE, on what the returns have been and what should be. And by bank, this will be very different. But on this ballpark number, if not 3 lakh crores, it will be 2.5. The total loss, so when we look beyond the pandemic, so assume that we see a 10% decline in GDP this year, we think that about 10% of that will go to the corporates. So about 50% of that loss will be borne by the government, lower taxes, some amount of fiscal spending, and about 25% of that will be wage earners, about 15% the informal firms, and 10% the corporate firms. That 10% is about 2 trillion. So if all of the corporates, the total loss is going to be 2 trillion rupees, it is, I think, unlikely that the banking system book value erosion will be 3 trillion rupees, right? Because there will be NPAs, there will be write-offs, there will be tax credit, etc. So I think there is, in our view, a clear opportunity in the corporate lenders. I would not say the same about retail lenders. The retail lenders, because there is a lot of erosion for wages, there is a lot of erosion in the balance sheets and the earnings potential of informal firms. All of that will, I think, sometimes show up in the retail lenders. So there we are still cautious. We are the lack of transparency is not going away in a hurry, right? But when you see this gross level of mispricing, maybe there is an opportunity in corporate banks.
It's a great point. My next question is something which in a sense is puzzling everyone, that why yields are going at 6%. One side you've got inflation which is transient, you've got a lot of liquidity, RBI is committed to stick to OMOs, LTROs, and yet spike in the bond yield to 6%, not once but twice.
Yeah, so I think that has been a problem for the last, I would say, at least 2 years, if not more. That we have, when we brought down the SLR levels for the banks, all of the banks now have excess SLR. So this is what you would call the market risk that they have taken. And if you periodically allow because the messaging that came out of the last MPC minutes, I think scared the market that the RBI expected and desired higher yields. Their actions thereafter have indicated that they did not. In fact, the governor has been saying in his pronouncements that he thinks that lower yields are important for better rate transmission. So that was the messaging, but I think the market interpreted it. And the market, because it had taken on a reasonable amount of risk, they just panicked, and therefore the yields went back. And then the RBI took measures and then brought them down. So unless we see some stability in the demand for bonds, while I would expect, so my own expectation is that, I would say, if I was prescribing, my prescription would be for the yields to be a lot lower than they are right now, right? But given the dynamics of the bond market, my expectation is that They may stay here, maybe drift lower. A very sharp decline is unlikely unless the RBI gives direct signals into the bond market. But my sense is that the term premium that we are seeing right now, if the repo rate is at 4%, and in this environment where the economy is still 10% below normal, we need to see negative real rates. And I would not worry too much. I mean, we can discuss about inflation as well, why I think current inflation numbers are not analytically useful. But I would, given that currently we should be thinking about negative real rates, I see no reason why the government yield should be so high. So I think we perhaps need more intervention and find more creative ways for creating demand for the 10-year bonds.
In your note, you are making a very interesting and a differentiated point, which is that one should focus on high-end consumption. And the stocks mentioned here, this is part of the report, Maruti and Eicher. I'm not getting into stocks, but I'm trying to understand that when the buzzword is rural and job losses are there, why should one focus on high-end consumption?
Great question again. So I think it is important when you think about that bucket of wage earners that I talked about. So as I said, about over 20 trillion rupee, 20 lakh crore GDP loss, if the GDP falls 10%, if it falls 12, 13%, maybe slightly more. I think and the fact that 25% of that goes to the wage earners, it is important to separate out the low income from the high income. Because the first thing is the top 20% of India's households by income, they generally save 40% or more of their income. So that's the first thing. So their consumption is generally far lower than what their incomes are. And in total, this is despite the fact that the top 10% in India consume pretty much the same as the bottom 50% in terms of the value of consumption. Services, which are the most restricted. So if you go through one by one, what are the services? What are the restrictions on the economy right now? Like say transport or restaurants or gyms or hairdressers or even if you think about ethnic premium clothing, which is I would say 15-20% of all clothing in India, in terms of value. The fact is that a lot of that is the lowly paid karigar working on some jarif or some heavy langa or something. So I think these are all procured by the higher income folks from the lower income folks. It's almost by definition, right? That the fact that you are using someone else's time means that their time is less precious than yours or something like that. Now, the fact is, therefore, that the wage earners, among the wage earners, the lower income sphere face the bigger brunt of it. They have less discretion on their consumption because there is very little discretionary consumption. So as we emerge out of the pandemic, so that's why we wrote that Beyond the Pandemic report, as we emerge out of the pandemic, they will emerge with higher debts and lower assets, right? Pawned gold, pawned assets, or more debt from friends and family. Whereas the consumption impact on the higher income is far higher than the impact on income. This is not to say that the higher income have not lost jobs or they haven't seen brutal wage cuts. All of those things we are fully aware of. But on a relative basis, they will end up with higher financial savings, which is what we are seeing, right? Higher deposits in the banking system, more flows in the retail market in terms of stock market. But these are, compared to deposit, these are small numbers, but the financial savings have gone up. So as we emerge out of the pandemic, you will have people who have ended up with higher savings. They did not take their annual vacation. They did not go to whatever the grandparents' house. The travel cost was saved. A lot of the festive events have not happened. So the regular expenditure on high-end apparel or Western wear, etc., means all of those things have been saved. So they will end up with more savings, and there will be more debt and assets at the lower end. So as the fear of the virus recedes, and if there's no virus, if there's no vaccine, maybe it'll take slightly longer. But if there is a vaccine, by maybe April to June next year, some of that fears. So you have the capability to consume. You're just not consuming because there's uncertainty. But as the GDP growth starts to pick up, or at least stops falling, you will find that there is that the propensity to consume among the higher income. So that consumption, I think, will come back much faster than the discretionary demand from the lower income consumers. That's the reason why we made that statement.
Great point. My next question is something which perhaps purely I want to share based on experience. When I started my career, the TMT boom was there, and you had about 200 to 250 IT companies in India. After the TMT boom, it contracted to 50. Only 10-15 companies have survived, and the leaders have only become bigger. Because of this pandemic crisis and because of what is happening because of GST and the slowdown, where do you think this kind of a disproportionate market share shift would happen, where smaller players will be out of business, or they will be forced out of business, or they will not like to remain in business? Do you think any disruptive market share change happening anywhere?
Yeah, so it's already visible. So the informal sector is already struggling, and it has been struggling the last 3-4 months. There are two reasons for that. The first is that their customers. So if you think about the typical consumption basket of a high-income consumer, there is most of their consumption is also from the formal system. Right. So, and therefore, it's not that they don't consume informal services or goods, or informally produced goods, but they do have disproportionate number of goods and services they consume are from the formal sector. The informal sector also, in a way, provides goods and services to the lower income population. So as of now, because that segment in terms of income is the worst affected. So that's one factor which is driving weakness for the informal firms. The second factor is actually the problem with the financial system, that the shallow penetration of the financial system is because a large part of the informal sector cannot get access to formal credit. So some of the monetary support that is being provided through rate cuts, etc., is not really available to the informal system. They're also a lot less. They have less access to debt when they're expanding. So in our report, we also explore how is the investing activity funded. So GFCF, gross fixed capital formation, which is a total investment a group of firms do. How is that funded? So for the formal firms, there is savings, an equal amount from borrowings. Then there is the depreciation, which is the cost of fixed capital. That pretty much becomes the GFCF for the formal firms. In the informal firms, savings become a much larger part because they don't have access to that borrowing from the financial system. And therefore, if their savings are hurt, they're literally eating into their working capital, right? They're literally eating into what would have been future investment and risk capital. And therefore, in many segments, be it insecticides, be it some types of consumer goods, where the informal sector has or processed food or paints. So wherever formalization is an opportunity, I think the formalization process will continue to be elevated. It is currently really high. Maybe it will come down, but it will be much higher than it was in February, because the informal firms' balance sheets have weakened significantly, and there is no easy policy tool to address that. See, you can cut interest rates, and so they effectively are taking from the high-income savers, the savers who are generally high income, and you are transferring that to the corporations or the borrowers. But how do you do that for the informal firms? Because they're not borrowing from the formal system. And because of that, the erosion in the book value of or the informal book value of those firms is actually going to be much higher, which is why I think formalization as a process could actually be much better or could be faster in the next 12 to 18 months.
Okay. So to wrap it up, Neelkanth, what should be the broad alignment for portfolio investors? I mean, where do you think right now this market is mispricing growth on the upside? Because Neelkanth, stock market is the only place where gold trades at the price of brass and silver in a bad market, and when sentiment turns, the same gold starts trading at the price of diamond. So where in the market right now gold is available at the price of brass or silver, and where do you think gold has got priced to the price of diamond?
Nice way of putting it. So I think that, as I said earlier, the banks which have a greater corporate focus. Now every bank has some corporate, some retail loans, but wherever I think corporate loans are disproportionate, those are banks which I think have been very badly hurt. This sector will be volatile. I mean, there are Supreme Court cases, there are regulatory changes that will happen, but I think there is a clear mispricing because there is a lack of clarity, and I think that lack of clarity has kept a lot of investors off. Once they come back in, I think there is an opportunity because the future growth, because from after March, it's very likely that we will be growing. And as we grow, the financial system still has a shortage of capacity, and some of these banks will have a great opportunity to price loans, get the best customers, etc. I think the IT services sector, which has done supremely well, so we put out a long lens, meaning why the IT sector deserved to be bought in June. It has done extremely well since then, but we don't think it is done yet because this is a sector which I think whatever be the trade barriers, there are structural factors that support it. And given its cash flows, the concentrated nature, as you rightly said, there were 250 of them. Now 90% of the market cap is in 5 firms. So 6 firms. So this is something that we think is in a good position, and we would be overweight on these. We do not think that, for example, the two-wheeler market, if low-income discretionary is, or rather, the discretionary capital or savings available for the low-income consumers is not going to be as high as it is for the upper income. I think the two-wheeler demand, cement demand, because what is it that is discretionary in the consumption basket of low-income consumers? And it is, the stuff that is listed, it is in a disproportionate way two-wheelers and cement. And both of these are sectors that we would advise investors to stay away from. Same with the investment themes in general. There are some stocks in investment which I think are cheap enough and are large enough and good quality enough where you may want to hold on. But as a sector, I think that resumption in activity or the resumption in demand, order books, look at the center-state tug of war, right? There are lots of nuances to it. I do not want to, caricature it like some of the papers have done. There are, I think, justifiable arguments on both sides. But what this means is that even though we've called the 50% of the GDP loss being borne by the government as water under the bridge, because it's a socialization of loss, right? The higher debt to GDP of the government, state and center, is more or less you and me and our kids, current and future generations, taxpayers, are bearing it. So it's been socialized, so the lasting impact of that is low. But within that, there is the nuance of how much is borne by states, how much is borne by center. States do a lot of capex, a lot more capex than the center, and their capex is also much more widely dispersed. So it's not one large project. Instead, there are many small projects, and therefore, in this kind of environment, you need that to happen. But I don't think that is going to happen, and therefore, this is a segment so investing is a segment as well that we would continue to. It is very cheap, or actually much cheaper than it used to be. But I think I would stay away from them. From a near-term perspective, I think for the next 3-6 months, the metals names can actually continue to do well because globally the supply chain bullwhip is hitting. So as supply chains get replenished in the tech supply chain, we just heard from our Asian Tech Conference that some large notebook providers, the laptop providers, are talking about being able to fulfill only 30% of the orders because the supply chains were disrupted. The demand for some of these goods is coming back. Same with autos, right? So as the supply chains get rebuilt, as construction resumes in the rest of the world, the demand for metals is actually going to go up. So, but that's more of a trade. It's not one of your 12-month, 24-month kind of investments. But I think, so that's how I'm looking at a portfolio right now.
Well, Neelkanth, really appreciate your time. We've had an extensive chat, but I'm so glad we've really covered all corners which really are important for our viewers. and for the broader understanding of those who track economy and are interested in knowing more about the markets. Appreciate your time, and certainly hope to see much more of you going forward.
Thank you.